Good day, fellow investors. This is a great comment here from Eustelfio. It's in Italian, so I'll translate it for you, where he says that everything is expensive. However, that even if you go into value, value might also crash in a crash because everything will be sold, correct? So are short-term bonds the only option, even if you might wait 10 years at zero real returns and the Buffett indicator might double in the next 6 years? That is a great, let's say, summary of the current market environment. And from a value investing perspective, he's completely correct, but we need to discuss volatility when it comes to investing, the markets and the personal portfolio volatility, valuation, the markets and your portfolio, the strategy, and then the last point, sanity. I haven't done a portfolio review in a while. If you have a portfolio of $1 million or more, maybe $500,000 if it's very interesting, please send it to my portfolio and I'll do an anonymous review, likely on YouTube. And I know you like seeing your portfolio compared to others and you enjoy the reviews. However, make it significant with a few millions, please. So, what does volatility mean? When it comes to investing, if something you own crashes 50%, are you happier or are you seeing it as a tragedy? I just did this video discussing 6 of my diversified portfolio positions. And then if something there crashes 50%, am I destroyed or am I happy? For example, Archer Daniel Midland just went down a little bit from this jump here, but if it goes from 56, let's say, to 30, what do I do? ADM at 30 is an amazing buy. It will give you then a dividend of 5.5% that you can buy and reinvest and own more at 30. So in that case, if something I own crashes, I'm happy because I can own more of it. Then the next question is, at what point something is value so that you can own more of it and being happy if it crashes? If the valuation is already good and if the driver of returns, earnings, dividends, buybacks, growth is already there from a fundamental perspective, so that if the stock price goes lower, you are even happier. And that is exactly what I said. Let's say we are here and then you can reinvest your dividends here at 5% yield, plus from here it will be 5-6% growth. That's a 10% return over time from a fundamental perspective. Then when the next food cycle comes, you get a 3x on top of that return, and that's how you achieve 20% returns over time, despite the market volatility that is always crazy. Don't focus on the volatility of the stock price. That doesn't drive your returns. This compounds your returns, the earnings, the yields. Which leads to strategy. Everybody is so focused, Sven, my stocks are going up, my stocks are going down, that they are completely missing the boat on what is investing for accumulating wealth. This is a nice chart that I always love to show. Yes, stocks always go up and then it's easy to think that it's all about stock prices going up. The same chart there shows you 10 years and the return is minus 50%. Same chart, look at this. So just from here, minus 50 plus 700. Okay, what will be the next 10 years? We don't know. Maybe it will be great, maybe it will be this. But if it is this, you need to compound value here and you need to compound value here. How do you compound value? You buy businesses that have driver of returns, earnings, dividends, buybacks, growth that gives you 10% returns. If then that business crashes, then you're even happier because now your returns will be 20% over time. And this is perhaps something that people fail to grasp. What if 7 years your returns are a meager 2% because your portfolio was volatile? Is that such a tragedy? No, that is something you have to accept as a normal investor. Happened to Buffett for many times that he had 7 years of zero returns. Happens to everybody. Accept that volatility. But if your fundamental portfolio is driven by fundamentals, that's how you make wealth over time compound. Because this the 1% dividend of the S&P 500, if the market crashes 50%, this is 2.3. This is nothing. This is complete destruction. So this is a bubble. This cannot sustain you in a non-bubble environment. We have seen it 2000s, 1990s bubble, and then very bad, and then money printing and everything. And now Trump is promising $2,000 to keep the bubble going. Okay, good luck. And this also shows the key drivers of YouTube. If I look at my videos, it is greed and fear. Stocks to buy now, so people are looking, okay, what are we going to buy? Everybody wants buys. And then there is also the crash, the fear, and those are the two topics that drive YouTube. I should have two channels, one exuberant bullish and one crash. I would have 10 times the views that I have now mixing things. It's crazy. So valuations matter if a bad decade comes. And then the strategy is to focus on that valuations because it's not price, it's about wealth we are talking. What does that mean? This is a perfect example and you see how you think, let me know in the comments. If you own 1% of Apple and the market cap is 4 trillion, is that better than owning 2% of Apple and the market cap is 1 trillion? Who is wealthier? When are you wealthier? Of course, the first one is 40 billion wealth versus 20 billion net worth. So it's better to be 40 billion, right? Well, if I then calculate Apple's annual dividend yield, which is 15 billion, if you own 1% or 2% of Apple on the market cap, depending on the market cap, here you make 156 million in dividends, here you make 312 million in dividends. Who is richer now? Yes, one has 40 billion, the other has 20 billion. This guy who has less worth owns more, thus makes more value over time. Stock prices go up and down, wealth is made by owning more. That's the key factor to understand. And when you can apply that strategy, as Buffett said, if you are a net buyer of stocks investing for the next 20-30 years, you always want cheaper prices. And we have many other of those quotes. The market may go up, the market may go down, but if it goes down, we'll be buying more at cheaper prices. That's the essence. If you liked it at 100, you should love it at 80. We relish the thought of buying more of a good thing at a bargain price. Which brings me to the fourth topic of this video, which is sanity. I'm looking at the comments. Trump is going to juice everything up and I'll be ridiculous when I discuss my 6-10% returns when everybody's making 20-30% on Bitcoin, gold and stocks. Further emphasized here, another comment, this that I discussed happened in the 2000s might never happen again, just a truly devastating, unforeseeable event. Here it happened, but nobody believes it now. Everybody is going to print money. There is no slowdown. The train must be keep moving, accelerating, and that's what everybody thinks now. Who is sane here? Who is insane? I don't know. I feel the market is insane, but I'm not betting against the market. No way. I'm just doing my thing. The boring have been doing 15% for the last 7 years. I'll keep on doing that. I hope the market does 20% and everybody's getting richer. The train never stops. However, history tells me it might stop. And I don't want to be on the other end if it stops. So see whether value investing is something for you. Check more of what I do. And I'll see you in the next video.